Last week's jobs report once again showed the labor market is just too strong for mortgage rates to come down, and it actually sent them to the highest they've been since May of last year. Jobless claims are dropping straight down, and total unemployment even came down a little bit. And with all of the freezes and the fires happening around the country, there was a big drop in the number of people applying for mortgages last week. Total inventory is still dropping, but new listings are growing. And we'll be covering all of this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end is my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button, and if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that's in the description below. Okay, today is January 13th. Let's see what the data is telling us, and if this is an old video, you can click the playlist here, and it'll take you to the latest weekly market update. Okay, starting with market news. The new jobs data came out last week and beat expectations, which sent mortgage rates to the highest they've been since May of last year. The labor market is still just too strong for any hopes of mortgage rates coming down. Total non-farm payroll increased by 256,000 jobs in December. Here you can see the unemployment rate. It had a small drop from 4.2 down to 4.1, but you can see it's just basically been going sideways since last May. Then looking at job openings, they did bounce up a little bit over 8 million to 8.09 million again, which isn't necessarily concerning at this point because you can see ups and downs of this size are normal, and overall the trend has been down. Though if we were to draw a line through these tops, it looks like it may be switching from a downtrend to more of a sideways. So we'll see over the next few weeks. This chart is the quits rate, and you can see it's been trending down nicely, and it's been back to pre-pandemic levels for a while now. And this one is important because during COVID, many people were quitting their jobs for higher paying jobs, which led to employers bidding salaries up and causing too much wage growth, giving people too much money, and causing inflation. So this has been going down. This one's been in a good spot for a while though. And then one of the most important charts in my opinion is the jobless claims. We've been covering this the last few weeks, but they had another big drop, and this one's important because it's going to be a leading indicator of the labor market breaking and ultimately of a job loss recession. But keep in mind, in order for us to be in the fear of job loss recession territory, we would need this to be well over 320,000 on the 4-week average. So not even just 1 week at 320. It would have to be averaging there. And as of now, we're headed straight down, and we're only at 201,000 jobless claims this week. So this is one very obvious sign that the labor market is not breaking. And this data reports every week, so it's the easiest to track. And then also the key sector that I care about most here is the number of residential construction jobs. And while this line isn't really growing much at this point, it's still very high, and it's not going down at this time. And the reason I care so much about this one is that mass layoffs specifically in the residential construction industry are typically a leading indicator of a greater job loss recession. So historically, when home builders stop construction, it means there is very bad news coming for everyone else shortly behind it. But as you can see, there's still plenty of residential construction happening, and we desperately need builders to build more housing to increase our supply so that prices don't go through the roof again when rates finally do drop and demand returns. So again, this is just more evidence of the labor market not breaking. So all of that is why mortgage rates are going up even higher. Until something starts breaking in the labor market, mortgage rates aren't going to come down. And I also wanted to bring up a lot of new construction over the holidays have been offering around, really as low as a 3.99. A lot of them have been in the 4.5 range in the lower price points. But with rates going up again, it's likely that those incentives are going to go away. Well, they're going to be a little higher. So instead of 4.5, you might see 4.75 or 4.99. Because the way it works is these builders pre-buy these discounted rates from investor pools, and there's an expiration date on them. So when they give these incentives, either they sell out of all the loans or these loans will expire. But in either scenario, they have to rebuy the next batch. And in many cases, they're spending $30,000 to $40,000 to get you that low rate when they pre-buy this. So now when they go back to buy the new discounted rates, that same $30,000 to $40,000 is not going to get them all the way to 4.5 since rates are higher now. So just know if you've been waiting, don't think the 4.5 rates are going to remain. I think it's likely they're going to go up to 4.75 or 4.99. I also know for the time being, some of the builders are saying the rate's going to go away and they're just going to give a dollar amount for now. amount, which when they just give a set dollar amount, it's not going to get you anywhere near those really low rates. When they pre-buy these rates, it's always a much lower rate than you can get to just from using a dollar incentive. So just know, if you've been on the fence or you've been dragging your feet, right now may be the last chance for 4.5 rates, at least until rates come back down some, and then they get to pre-buy those loans. And like, I had a guy go under contract yesterday, and yesterday was the last day they would give their rate incentive because it could close this month in the next 18 days, which is when those rates would expire. So that's that. Let's move on. Starting with national housing inventory. This week we had a decrease of 11,013 less homes for sale in the country. This gets us down to 24% more inventory than we had last year. And it gets us to a total of 624,419 homes available for sale in the country. This same week last year, inventory was only at 505,186, so we're still much better than last year. And then for reference, the all-time inventory bottom down here in 2022, we only had 240,000 homes for sale. The peak of last year, we had 740,000 homes for sale, so we've come a long way. And this same week in 2015, we had about 925,000 homes for sale. So we're hoping that this year, this line is going to continue up closer to what you see in 2019, and that's going to get us much closer to a normal market in the next year, maybe 2 years. Now looking at new listings. So this is our first kind of actual week of data that wasn't skewed by the holidays, and you can see we got a nice big rebound that got us up over the previous 2 years. We have about 5,000 more new listings this week than the same week last year, for a total of 44,639 new listings. Now looking at pending sales, this week we have just 1% more sales pending, that tiny sliver, than we did last year. And this is not unusual. The data gets very tight at the beginning and the end of the year. But overall, as you can see on this chart, it's likely that this week, maybe next week, is going to be the very bottom for the market this year as far as number of homes pending. And very soon we're going to start trending up. And you can see we trend up pretty sharply. But this week we have 252,586 homes pending in the country. Then the last thing we cover nationally is a percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we're starting with 33.94% of homes taking a price cut last week. Last year we got as high as 39.9. The year before we got as high as 39.2. And in 2022 we got as high as 43.2. And right now we're in the middle of the last 2 years. And just know, if you want home prices to come down, then this number would need to be going up. Okay, moving on to mortgage rates. Let me clear these out. You can see we have been going straight up. We're the highest we've been since way back here at the end of May. So we started the week at 7.1, and then we got our jobs report. We ended it at 7.24, and right now we are nearly 0.5% higher than we were this week last year. We're 0.46% higher. At the end of the last 2 years, rates were dropping at the end of December into January, and this year is totally different because they are going up. Then regarding mortgage purchase applications, we had very few people applying for mortgages last week. Some of that is seasonal, but also there's just a lot going on in the country right now. Several states were worried about this big freeze coming last week. Here in Dallas, I was driving the whole time. It was fine. But either way, when people get worried about stuff, they just don't do anything. And then of course we have the fires going on in California. But yeah, anytime there's disasters happening, even if it's not directly in your state, people will just put big decisions like buying a house on pause. And also, as I just mentioned, mortgage rates are nearly 0.5% higher than they were last year, which just literally means a lot less people are even able to qualify for a mortgage. But I've been saying it for more than a year now, and I still believe it. We're not going to see a significant growth in housing demand until mortgage rates get and stay below 6% for a sustained period of time. That's where demand is. We see that in new construction that's been offering below 6% for a long time, and they've still been selling tons of homes. Now let's move on to the local market data. We're starting with the MLS data of Dallas County. And this year we're using a new spreadsheet. I have not had time to update that chart, and honestly, it's not looking like I'm going to do it anytime soon, but at least we can see here where we can see the plus and minus from last week. I'm gonna try to get it on a chart. But this week we had 487 new listings, which is 103 more than last week, 145 closings, which is 77 less. Of course, that's still corresponding to the holiday. The number of homes that were immediate sales, that means they contracted within the first week, was down to 16. Again, the holidays, that's 17 less than the previous week. We had 223 contracts, which is 40 more than last week. And in total, there are 1,725 homes either under contract or pending, and that's 63 more than last week. Now looking at Collin County, we had 342 new listings, which is 107 more than last week, 124 closings, that's 79 less. 16 were immediate sales, that's 8 less. We had 131 new contracts, that's 16 more. And in total, there are 1,345 homes either under contract or pending, that's 53 more. Okay, now we're moving on to the Market Action Index. If you've never seen this, it just takes into account all of this data, puts it into one easy to read graphic with a number. Anything below a 30 is a buyer's market. Above a 30, we're asking how much of a seller's market are we in? And really, we just use this data to see, are things looking normal or is there something we should be concerned about? And overall, you can see the Market Action Index has been heating up. It was curving up through December. We had our holiday slump and now we're back up. So it's too soon to tell how these higher mortgage rates are going to affect things, because seasonally we should be starting to heat up in the next few weeks. But if rates keep going up, who knows what's going to happen. But overall, median list price is still holding firm as where it was in December. Median price of new listings had a big jump though this week, but we never look at 1 week data. We're always looking for trends. So if you take the sum of all these ups and downs, that's pretty much just flat. So this could come right back down and just continue the sideways. Average days on market had a drop for the first time from 110 down to 106. Median, which is of course a lot slower, is still at 77. Number of homes having a price decrease is obviously trending down, which again, all of these types of things are showing that, okay, December and the beginning of January, after that is when things heat up. You know, prices are always lowest, incentives are biggest, right there at the end of the year. Things will start heating up from here on out. It doesn't mean prices are going to go straight up. It just means we're going to see things like this. Less homes are having price decreases, median price of new listings going up. Those types of things are normal. Inventory is continuing to drop, 4,277 down to 4,100 this week. And of course, we can see the sum of all that data is the Market Action Index is going up. That means the market is slowly heating up, which is normal for this time of year. Now looking for the same thing at Collin County, they actually had a big drop in their median price of new listings, but again, Collin County has a lot of new construction, so this could be as simple as some new lower price communities just opened up. You know, maybe they had their grand opening this week, but we're always looking for trends. We can see though, this trend has been more down than sideways. But again, this could bounce right back up next week and it's going to look totally sideways. But also their overall median list price is still trending down. So, and it's obvious their Market Action Index as well, it's lower than Dallas and has not been heating up as kind of consistently as Dallas. So not really unusual that prices would still kind of be trending down. Would not expect that to last much longer. Their average days on market as well dropped. Their number of homes having price decreases is continuing to drop. So those things would suggest prices are probably going to turn around. Their inventory had actually a little jump up this week instead of Dallas, which was going down. So overall things are looking normal. Dallas County is looking hotter than Collin County, but nothing to be concerned about in either. Now we're moving on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin County. These are ranked using that same Market Action Index number we just described. So starting with the absolute hottest cities, the absolute hottest remains Carrollton, Texas at 45.56. It's been there for a very long time. Ferris, though, heats up 5 spots to take number 2 this week. Grand Prairie heats up 1, Coppell cools off 2, Plano heats up 2, Richardson cools off 3, Louisville cools off 1, Balch Springs cools off 3, Grapevine jumps on at number 9, and Irving jumps on at number 10, and then Seagoville and Princeton, which were number 9 and 10 last week, fell off the list this week. Then we like to zoom into specific zip codes. Carrollton 75007 is the absolute hottest at a 48.28, followed by Grand Prairie 75051, Plano 75093, Plano 75025, Irving 75060, Grand Prairie 75050, Grand Prairie 75052, Dallas 75238, and Carrollton 75006. And then at number 10 is Richardson 75081. So if you own a home in one of these zip codes, then you should be able to sell for top dollar. Then the same thing, looking at the coolest cities and zip codes, the absolute coolest remains and has been for a long time Blue Ridge. Remember, a 30 or below is a buyer's market, so all these up until Anna are officially buyers markets. So Blue Ridge is number 1, Leonard number 2, Sunnyvale number 3. Those all remained in the top 3 spots. Anna cools off 1, Lavon cools off 1, Van Alstyne heats up 2, Rockwall and Red Oak remain in their spots. Nevada jumps on at number 9, and Royce City heats up 1 to take the hottest spot on the coolest cities list, and then Salina, which was the hottest city last week, jumped off the list this week. Then looking at the coolest zip codes, Blue Ridge 75424 is the coolest, of course, at a 26.19, followed by Leonard 75452, Sunnyvale 75182, Rockwall 75032, Anna 75409, Dallas 75219, and everything you've heard so far, those are all buyers markets on the zip code level. And then Lavon 75166, Van Alstyne 75495, Red Oak 75154, and Grand Prairie 75054. Those are all just barely outside of being buyers markets. As always, if you're looking to buy, sell, or invest in the Dallas-Fort Worth area, call, text, or shoot me an email. I'd love to connect. Thank you for watching. I'll see you in the next video.